I've decided that the analysis of open market operations is a bit too complex. So although they are included in the notes, I'm not going to make videos of that. So instead, I want to wrap things up by thinking about some applications of the ideas that we've been talking about, and in particular, discuss the implications of setting surpluses independently of debt. How do we interpret what this equation means? Well, again, on the left-hand side, what we have is the goods value of initial debt in the economy, initial government debt. And what we have on the right-hand side is surpluses that back debt. But what I want to emphasize is that we can think of this equation as the equation that values government bonds. So like any asset, government bonds derive their value from the expected discounted cash flows. In the case of stocks, value comes from the expected dividend flow that the stockholder is going to receive. In the context of our models, we have talked about the consumer owning the firms, and so therefore the value of the firm depends on the flow of profits that come from the firm. But you can think about government bonds analogously, that these are just assets and they derive their value from the expected returns, the expected cash flows. Now, in the case of government bonds, those cash flows are these primary surpluses plus seigniorage. That's the curly S. Now, there are really only two options for how equation 9 is going to get to hold. One is that if the price level gets nailed down by monetary policy, then these two things have to be endogenous and they have to adjust in order to be consistent with whatever the price level is that monetary policy is determining. On the other hand, if these surpluses are determined by the political process and are largely independent of debt, well, then this price level will adjust to make sure that equation 9 is consistent. And then, as we've seen, monetary policy has to accommodate whatever equilibrium price level gets determined by this equation. The conventional view assumes option 1, surpluses can and always will adjust, and the alternative view entertains the possibility of option 2. But when these surpluses are exogenous, then, as we've seen, a cut in current or future taxes will reduce this whole right-hand side. And when that right-hand side goes down, we're going to need to have the price level go up to establish equilibrium. For the past 5 years, real interest rates in the United States have been extraordinarily low. In fact, they've even been negative at times. What that does is it raises the present value of these future surpluses. And that increases the value of government bonds. People then want to substitute out of goods and into government bonds. So that reduces the aggregate demand for goods today, and that then drives down the price level today. But real interest rates, we assume, will eventually return to historical levels, which are sort of in the neighborhood of 2 to 4%. And when that happens, this present value of surpluses is going to fall. Bonds are going to become less attractive. People are going to substitute out of holding bonds and into buying goods, and that's going to drive up the price level and inflation. So what you should see here, if you think about monetary policy as raising interest rates in order to reduce inflation, this is an environment when these surpluses are exogenous, where raising interest rates actually raises inflation. Now, what's going to happen when the U.S. economy returns to normalcy? So as I just said, interest rates have been extremely low, And in fact, the Fed has kept the nominal federal funds rate at about zero for the past 5 years. The 10-year Treasury rate averaged 1.8% in 2012 and 2.3% in 2013. But the 50-year average for this 10-year Treasury rate is about 6.5%. So there still is quite a big gulf between the historic average and current levels of these 10-year bond rates. As the Fed returns the federal funds rate to normal levels, Treasury rates will also start to rise and return back to normal levels. Net expenditures on interest on the federal debt will then end up rising from the current level of about 7.8% to almost 30% of total government expenditures. That's a huge fraction of expenditures by the government. Those interest payments then are going to raise the deficit by about $1 trillion. Now, in the conventional view, what that's going to require is that these surpluses adjust by $1 trillion in present value. So the real question is, can we count on this fiscal adjustment to occur? If not, then we're going to be in the alternative world. So when thinking about whether we're going to go back to the conventional policy mix, which is what most people would mean by returning to normalcy, we need to think about the spillover effects from monetary behavior to fiscal policy. So to wrap it up, we've looked at two canonical policies. Well, we really focused on the tax cut. The notes include the open market sale. And equilibrium requires that monetary and fiscal policy be consistent. And what that means is that they have to deliver the same solutions for prices. There are two ways to make policies consistent. The conventional way has fiscal policy adjusting to monetary policy, and the alternative way has monetary policy adjusting to fiscal policy. But these two ways imply very different views about what macroeconomic policies do. Now, this alternative view is actually quite subversive. The conventional view underlies how countries have designed their central banks. So what countries have done is they've made their central banks independent, so therefore monetary policy can take the first move in order to determine the price level. And in many countries, we've told central banks that their job is to target inflation. But then fiscal policy has to cooperate and behave consistently in the way that we've been talking about, in that sort of Ricardian way. Now, in some European countries, fiscal behavior is not consistent with having the European Central Bank target inflation. And in the United States and Japan, at least recently, fiscal policy has not been consistently Ricardian, as this conventional view dictates. But the inconsistencies between monetary and fiscal policies can have profound implications for inflation and interest rates and overall macroeconomic performance.